Forex divergence. In this video, I'll explain everything you need to know about Forex divergence. What is the difference between regular and hidden divergence? How to trade regular divergence? How to trade hidden divergence? How to choose a proper divergence indicator and how to use it? We will also discuss the fundamental errors that the majority of traders make in trading divergence. I will teach you the basic fundamentals you need to build your own profitable strategy to trade on the Forex market. What if you already know everything about divergence and you think that divergence gives many false signals? Watch this video to the end and you will learn a lot of new interesting things about divergence, and the number of false signals will be reduced by several times over. Don't believe me? In each course, I will give you information that you will not find in any book or on any website. I've been studying the Forex market for 10 years, setting up a team consisting of mathematicians, programmers, and traders. We've created more than 2,800 indicators, robots, and professional Forex software tools. Every one of my losses or gains on the Forex market have given me practical knowledge, which I would like to share with you. Let's move forward. Let's take a look at classic or regular divergence. There's several kinds of divergence, but the most widespread one is the classic or regular divergence, or in other words, a reversal pattern. It's subdivided into the bearish divergence and the bullish divergence. The bearish divergence occurs when there is a trend reversal from up to down. In other words, when there are lower highs in the oscillator and higher highs in price. The bullish divergence occurs when there is a trend reversal from down to up. In other words, when there are higher lows in the oscillator and lower lows in price. As a rule, the regular divergence shows that the current direction of price movement may change and that a top or bottom could be very close. I would also like to note that there are several ways to find Forex divergence. I recommend to look for the discrepancies between the levels of fractals on the chart and the levels of the indicator. I call this divergence fractal divergence, and this divergence is most accurate and gives fewer false signals. A fractal is a series of at least 5 successful bars with the highest high in the middle and the 2 lower highs on both sides. The reversing set is a series of at least 5 successive bars with the lowest low in the middle and the 2 higher lows on both sides, which correlates to sell fractal. Standard Bill Williams fractals have period 2, 2 plus 1 plus 2 equals 5 bars. I use an extended version of fractals with a custom period. If fractal period equals 1, we get 1 plus 1 plus 1 equals 3 bars model. If fractal period equals 3, we get 3 plus 1 plus 3 equals 7 bars model. If fractal period equals 5, we get 5 plus 1 plus 5 equals 11 bars model. The smaller the fractal period, the less probability that we will pass the signal. However, there's a higher probability of a false signal and vice versa. I use 5 to 7 bars for left-hand fractal forming and 3 for right-hand fractal forming. It's never too late. So, a signal to buy is when a new low fractal is formed below the previous one and a corresponding indicator value is higher than the previous one. A signal to sell is when a new up fractal is formed above the previous one and a corresponding indicator value is lower than the previous value. So, let's take a look at the hidden divergence. It's not as widespread as the regular divergence, but it can be much more effective. The main difference between the regular divergence and the hidden divergence is that the latter is in a continuation pattern. One more time for review. Regular divergence is a reversal pattern, while hidden divergence is a continuation pattern. There are 2 subdivisions of the hidden divergence, the bearish hidden divergence and the bullish hidden divergence. The bearish hidden divergence confirms that price trend is down. In other words, that there are higher highs in the oscillator and lower highs in price. The bullish hidden divergence confirms that the price trend is up. In other words, there are lower lows in the oscillator and higher lows in the price. Hidden and regular divergences are 2 opposite kinds of divergence, but hidden divergences are more useful for traders because they can show the exact entries in the direction of the trend. Hidden divergences increase a trader's chances of success because they help traders get into a prevailing trend. Moreover, hidden divergences help traders to find the precise entry, stop, and exit levels in a trend. Successful traders know that the trend is your friend, so follow this simple but useful rule. So, do you think this knowledge is enough to become a profitable divergence trader? I can answer that for you. Of course not. The second component of success in trading divergence is the correct selection of indicators. A little ahead, we'll take a look at the third component of success, which is the rules for finding the entry point in the position and exit point from the position. While we're still on the subject of indicators, let me point out that the market may be in several states a trend or sideways movement. A market trend is a tendency of a financial market to move in a particular direction over time. These trends are classified as secular for long time frames, primary for medium time frames, and secondary lasting short frames. Let's say, for example, that the market is moving sideways. In this case, the best oscillators are the True Strength Index, Indicator Stochastic Divergence, RSI, RVI, WPR, Momentum, and John Eller's Adaptive Cyber Cycle. At the time trend of the market, these oscillators will give many false signals sent to the opposite side of the trend. For trend domination, better ones would be ADX, MACD, TRIX, and No Sure Thing. For trend domination, I recommend to check 4 time frames: the time frame on which you intend to trade, 1 lower, and 2 higher time frames. Now we know how to find regular and hidden divergence, so we will create rules for trading strategy. First, determine market condition using the indicators ADX, MACD, TRIX, No Sure Thing, and look through 4 time frames. If the market is moving sideways, follow regular divergence signals from the indicators True Strength Index, Indicator Stochastic Divergence, RSI, RVI, WPR, Momentum, and John Eller's Adaptive Cyber Cycle. Open position only after you receive a divergence signal and the price will touch the line of support/resistance. Place stop loss under support/resistance line. Price moves in the expected direction. When the price touches to the next support/resistance line, check the hidden divergence signals. In the case of a hidden divergence in the expected direction, save the position and look forward to the next support/resistance line. In the case that a regular divergence signal appears in the opposite direction, close position and open the opposite position. In the case of a trend, open position in the trend direction. When the prices touch the support/resistance line, check the hidden divergence signals. In the case of a hidden signal divergence in the expected direction, save the position and look forward to the next line. You can close position or part of position if you do not find a hidden signal divergence in the expected direction.